All right, everyone. Hey, very nice to see you all. We are getting going. It's kind of a soft roll into the opening of the experience, but hey, we're excited today to have a conversation, really talking about, super powering startups and really how to power up our back office. Before we get going, we're going to allow a few more minutes for people to kind of jump in here, but obviously people will be joining whenever they can and they whenever they're able to. But a couple housekeeping things here. We've got a chat box, and we just want to make sure that you're aware of that. And I'm just gonna say hi here. So say hi. Hey, feel free to share if you want to share your LinkedIn just to connect with people. That's great. You want to say hi, but also if you have any questions, let us know. You can type the question in the chat. We will pull that up. Hey, maybe even invite you onto the stage if you want to unmute and maybe go on camera. You can ask the question and we can have a discussion. But this is a group conversation as well. All right. We're here to answer questions as well. But hey everyone, want to welcome you to Founders Live Conversations. I am Nick Hughes. I'm the founder and CEO of Founders Live, and so excited today to have a very special guest, very meaningful to Founders Live as well. We have Mairtini from Countsy, and she is the CEO, and Countsy absolutely powering back office of startups. We're going to find out and learn a lot more about what that really means and why it's so valuable. But Mairtini, thank you for joining the conversation.
You're very welcome. Good morning, everybody. My name is Mairtini. I'm the founder of Countsy. Just a quick update on Countsy. We're not here to talk about Countsy. We're here to talk about your back office. But really, we outsource accounting, finance, and HR exclusively for venture-backed startups. So our whole world is living in tech, life science, CPG, all kinds of startups. Whatever you are, we're doing it. We typically focus on US startups. So I know there might be some international people on this call, but our whole goal is that our founders don't have to worry about that back office, that they get to focus on the tech or the science that they're building, and that they're able to really rely on a good service in the back that's keeping everything sort of going and running smoothly. And some of the stuff we're going to talk about today is why that matters, honestly.
Yeah, well, thank you. And we've been working together for a few months now, and absolutely love what you stand for. And I think that that's part of obviously why we've gotten in touch, and a lot of your team, whether they're in the Pacific Northwest, Seattle, where we're headquartered, or I know that you're based in the Bay Area.
California. Right? I'm in California. I'm in Menlo Park. Our office is in Mountain View, so very much in the Silicon Valley.
Great, great. Well, it's been incredible to work with your team and you as well. And so we're here to really talk about back office powering startups. And I think the angle we take here from Founders Live is there's so much. So what we say with anytime we describe Founders Live is we're an ecosystem that powers the pulse of entrepreneurship. We're an ecosystem that brings connection, education, which this is what we're doing today, also resources, and helping startups understand the things that are needed and required to actually operate their business, and then exposure and discoverability. And so we're hitting a number of things today, and we're really talking about, in the end, to see a successful startup, there's really things that are required. And, if we want to start with really what is the back office and why is it so important? What does that mean? How should startups approach really thinking about building out and having what would be called a back office? Let's just start there.
Sure. I mean, what we consider at Countsy your back office is your entire accounting function and your people HR function. Certainly, there's some legal associated with back office, but from a point of view of functions within a company, it's really your accounting. What's accounting? I often talk to founders when I'm talking to them first. Founders have this sense that accounting is AP, accounts payable. There's a lot more to it than just paying your bills. Just like on the HR side, there's a lot more to HR than payroll or the people side. So an accounting function typically is just a way to maintain the money that's flowing in and out of your company So you're going to have some receipts, you're going to have some outgoings. All of that stuff needs to be maintained in a general ledger system, some sort of a system that you're able to produce a set of GAAP financial statements or even cash-based financial statements. You can't really do it on a spreadsheet. On the people side, it's not just payroll insofar as of course, you have to pay your people timely and accurately, but you have to make sure you're protecting your startup, that you've got a proper offer letter, that you've got a proper CIA in place, that you're really managing your IP as regards the location of your employees. So we think back office is really those two sort of pillars with some other stuff in between.
Very good. And when you engage with startups, or you're obviously, not only do you focus on them, with your, some customer segment, but also you're in the Bay Area, you're in California, you're interacting with a lot of founders and startups. What do you advise or suggest? When should they start thinking about HR and accounting and really this back office stuff? Is it 2 years after they've started, or is it literally like, hey, as you are starting this company, you're incorporating, you're building your team out, it's literally day one, you got to start really thinking about this?
You need to start thinking about it from day one. But I kind of have this trite little thing I say, that if you have nothing to count, you have nothing to account for. So you got to have some money running in and out of the bank account. So as soon as you start spending the corporation's money as opposed to your own money, one of the things we're going to talk about on this call is what if you're funding the company yourself on your personal credit card. But as long as you have an EIN, you have a legal entity, think of that as a third thing. So it's not you, it's not your money, it belongs to the legal entity. The government's perspective is that that's a separate legal entity. So you need to track things separately. So I think about it from day one. Once you have money flowing in and out of the bank account, though, you really need to think about it. From a payroll and HR perspective, as soon as you hire either a consultant or a contractor or put someone on payroll, you need to be doing that right and have it clean. On the consultant contractor side, got to have a contract, got to have a confidentiality, an assignment, a confidentiality invention and assignment agreement. Same if it's an employee, got to have a defined offer letter and a defined invention assignment agreement to protect the IP.
Yeah. And so you're mentioning all these assignments and agreements, some people on here, if that's foreign to you, it's okay. It's okay that you're like, wait, what is she talking about? Where would you point people if they wanted to go find, like either templates for those things, or who would they talk to get those things in place if they are like, oh shoot, I think we do need those documents?
Yeah, I mean, they're really legal documents, and we generally find, I mean, no matter how early your startup, if you've done that thing I just talked about, you've created an EIN, you've formed a corporation, you got to have some sort of legal advice. Whether that's hourly legal advice that's very low cost to you, you only use it as you utilize it, or you have an actual corporate law firm. Generally, we find with tech and life science and venture-backed startups, as opposed to sort of family-owned startups, you need a corporate lawyer to do those templates for you. Listen, most of the law firms that work in this space are willing to do some very early stage work with companies, either on a deferred billing basis or on a low cost basis. Once you engage a corporate law firm, it'd be unusual for them not to say, here's our offer letter template, here's our consulting template. They like you to be using their templates. Now, of course, you can go to the internet and find some. Obviously, you can do that. Just there's a little bit of risk there. For example, that you'd find something that isn't compliant to the regulatory environment you're in, whether you're in the US or Canada or Mexico or whatever. So I know it sounds costly, but the best place to get that, Nick, is from your law firm or from a law firm.
Yeah, good. I'm glad that you suggest that, because I think that that's the most sound advice on that. Hey, as we keep going here, definitely I want to bring on and include Luis Antezana, who's a part of our team here at Founders Live. So,
Hello.
Luis, say hi, and maybe toss in a question here that you've been thinking as well.
Yeah. Hi. Good to have you on the show. I'm wondering, the founders are often like really confused about when to start, and I know you're just talking about like what's should you start from day one or whatever, but like, is there any kind of like mind switch flip that they need to make for whether it's like just to know that the county is for them, that their process is that they're I'm sorry, I'm kind of stumbling for words here, but it's like,
I think I understand what you're saying. I would say if you're a founder and you're spending sort of your own money and you haven't put people on payroll, you haven't hired contractors, you probably don't need a service like us or any service really. Even if you have an EIN, as long as you have your bank account, as long as you're tracking your spending, you're keeping your receipts, you're in great shape. I think where it starts getting tricky is when you either start having contractors and employees and you start having customers. There are two things that sort of ratchet up the complexity of your business and your exposure to risk. So once you have a consultant or a contractor and or an employee, you're exposed to risk, right? So let's tie down that risk by having proper agreement in place, by making sure you're running that through a payroll system, or if you're paying them as a consultant, that you've taken account of the risk of whether they should be on payroll. We can talk a bit more about that if you like. And so like I say, it's when you sort of have more than just you and your money in the business. And you can still self-fund and have employees and contractors, but that sort of ratchets up the complexity to me when you need to start thinking about having some professional advice. And of course you can try and do it yourself, but do it using proper tools. Don't sort of, ham fist your way through it.
Yeah. So so once somebody gets into it, and they might have a very small team, is this one of those situations where like they rely on you to take care of all this stuff, and they can check in with you like monthly or something and just kind of like take that load off their shoulders? Or do they feel like they have like, oh gosh, this is going to be a whole thing I got to get into in addition to everything else I worry about?
I mean, I don't want this to be a sales pitch for Countsy. Obviously, I do. We're very much focused on helping founders. But yes, I mean, if we're working with companies, we're doing all this stuff, right? We're running the payroll, paying the bills, closing the books. We have to interact with the founders a little bit, but we're doing all of that. So if you are going to work with a service, you do need to decide how high touch you want that service to be. We're pretty high touch. We kind of feel that startups are pretty high touch, right? Every vendor's a new vendor, every employee's a new employee, every consultant's everything's new. And once everything's new, it sort of needs a bit more touch as opposed to same old thing that we've done 55 times last week, So yes, we're pretty high touch. The service.
It's great to have someone you can trust, because like founders are often used to just trying to do everything themselves, and offload something is a nice thing. Yeah, thanks.
And actually can be hard for founders, right? Because a lot of founders and a lot of people feel, geez, I've got an advanced engineering degree from MIT. I can figure out the bookkeeping. And sure, you probably can. And with loads of founders that are super smart, but where they get tripped up on is stuff like they don't know when the tax filings are. Oh, I have to do a Delaware franchise tax return. Oh gosh, I didn't ever fire that office payroll and pay them as a consultant and whatever, all the things, right? So it's not an intelligence test, honestly. It's really more, where should you be focusing your energy? Any founder that's spending a significant amount of their time on back office, it's really a waste of your time. Time is so precious in startups. It's all about time. Like it's all about the speed to product, right? So if you're spending your time on anything other than that, it's sort of interesting. I think you do need to sort of reflect on that.
Well, this is good. That's maybe a good segue to, you've seen a lot, you've worked with a lot of companies as well. What would you say maybe 2 or 3 biggest mistakes that you see founders make in this approach or not approaching, really creating the back office and all the things, whether it's the financial aspect or the HR?
Yeah, really the biggest one. So when I think about mistakes, most things can be fixed, right? So you kind of categorize what's fixable, but then have you the time to fix it? So the issue with not doing things right from the beginning is when you need it, you kind of need it. No VC is going to come to you and say, oh, I'll give you 3 months to figure out all of that. I'll come back with my money. That's not the way it works, right? So I kind of feel that the mistakes you can make are very much around employees, IP, your cap table. Having a messy cap table is going to be very off-putting. So if a VC comes to you or an outside investor says, I want to see your cap table, and let's just say you show them a cap table that has you, the founder, and one other co-founder, and nobody else on the cap table. But then they say, but what about those consultants that you have? How are you paying them? Didn't you tell me you're paying them with equity? And your response is something along the lines of, oh yeah, we haven't papered that. We haven't agreed on how much equity they own. That's a real trigger to an investor to say, oh, how much of this company is actually even available to be invested in? So cap table pristine, never any question on who owns equity, and never sit around on granting equity. If you've committed to giving somebody equity, get it granted at the valuation of today, whether that's as a common stock or an RSU or as an option grant, whatever it is. Don't wait on equity. Equity gets stale super fast. So I think that's really important. Pristine cap table, understand the ownership, understand what's available, etc. And then I think around employees, because startups are all around the technology and the IP that you're building. So if there's any leakage there or any opportunity for leakage there, it's a real off-put. And I'm not telling anyone on this call anything they don't know, but even if it's your best friend since childhood, even if it's, a family member, have it on paper, have a contract in place. What is the service they're offering? What is the protection around the IP? It's typically called a PIAA or a CIAA, a confidential invention assignment agreement, that you sign just to make sure that this IP that you're developing belongs to the company. You don't get to take it with you. Often when people fill those out, if they have existing patents or whatever, they're listing them out so that they're protected too. So it protects everybody, gives everybody a sense of protection, having those documents in place. They're the biggest things. The fact that you haven't reconciled your bank account is not going to stop you getting money. But the fact that you haven't got signed offer letters, signed consulting agreements, a clean cap table, is going to be a barrier.
Those right there, everyone. That is really, really, that is good stuff. And, clearly very, very important.
Yeah.
You just heard her say, if these things aren't in line, there might not be a check for you or, a wire transfer from that investor. And that would be terrible, right? And, maybe you have the most amazing team and amazing new technology, but they just don't want to touch this because it is messy and there wasn't care in the beginning to make sure that proper steps were taken. This is really, really important stuff.
One other thing I wanted to mention, actually, and this is kind of a bit more esoteric. Most people don't know this, that the very last thing, you can be in a due diligence process with an investor and they might not care about the financials. They might not ask to see anything. They might be very interested in your technology or your invention and they want to put money in. But the very last thing an institution will do, if you're dealing with an institutional investor of some sort, they go through the whole process. You can have a signed term sheet. You can have a commitment. You can have sent them your wire details. The day they send the wire, it is a process on every law firm that they do what's called a good standing check on your company, on your legal entity, on your EIN. What's a good standing check? That means they go out to Delaware or whatever state you're registered in. They go out to the IRS and they run your EIN through that process. And it has to come back in what's called good standing. Good standing means you've filed your tax returns. It means you've done your Delaware franchise tax return. And if you haven't got a good standing check, if it comes back as a fail, you have to cure that before they'll invest the money. And we have seen that where it's just something that founders just didn't even think of. And it's such a silly thing because it's really a compliance thing, right? But you do have to go through that process. That's the very last thing that happens. Most founders don't even know it's going to happen. No one tells you, oh, I'm about to run your good standing check. They just do it.
Yeah, and that brings up a question. Is there a way for us founders, CEOs, to do a good standing check on our own, do diligence on ourselves to then make sure that I didn't know that, so we need to go take care of that before it becomes a problem?
But you can certainly do a good standing check with the Delaware court or the Delaware system. You can get onto delaware.gov, xd.gov, and put in your EIN. And there is a point where they might ask you for $10 to run the check. But I guess I would say with the IRS is a bit trickier because the IRS is just the IRS. But you would know, right, if you've filed your tax return. And I guess on that point, if you've had a legal entity, like if you founded it a year ago or 2 years ago, even arguably if it was dormant, you founded the EIN, you didn't do anything in it, there is an argument that you need to file a tax return. It's a $0 tax return, so you should be able to do it yourself, but get those tax returns filed. The IRS don't like 2 or 3 years in coming back and filing a tax return. And certainly if you had dollars moving in and out of the bank account, even if it was just dollars moving out of the bank account, even if it's loss making, even if it's only $10,000 loss making, you got to file that first tax return.
Yeah. Okay. So, note that, everyone. I think, there's some things to do. I would maybe add, I'm just suggesting, I guess, that was a Delaware suggestion, but, maybe at any state that you're registered in, you can go to that. We're registered in Washington State, actually. And so, you can go on there, and we interact with the, Secretary of State quite a bit on their website. So just, note that, everyone. I think this is a very, very important thing.
Yeah, I should assume Delaware, actually, because that's something that's changing, right? We're actually seeing a lot of companies move out of Delaware. Well, not a lot, but it certainly seems to be something that people are talking about, whether it used to be just a default if you were going to raise outside money, because the whole thing about Delaware is that it protects directors and officers, right? So that's why people chose Delaware. I'm not sure people understand that. It was because Delaware supposedly had the most director and officer friendly laws. That's why people chose Delaware. But we're actually seeing a bit of a shift from that into more Nevada and other states too.
Yeah, interesting. So Emerald, I just want to point out a question here is, so just to clarify, if there is an EIN number, then you probably should make sure that you check in and at least attempt to and try to file a tax return regardless.
Yeah, because if you have an EIN, you've created the legal entity. That's how you get an EIN. You've gone to the IRS, you've asked them, you've said, I've created a legal entity. Here's my corporation number. You get that from the lawyer or wherever you created the entity. And then you get back from them what's called an SS4. And they give you your EIN number. So once you have that, as far as the government is concerned, you're a legal entity that's operating and doing business. So yes, once you have an EIN, even if you haven't opened a bank account, you're better off submitting a $0 return.
Yes. And hey, Emerald, just so you know, I've done that a number of times in terms of so we created, this is kind of a side note, but this is fun to talk about. We created Founders Live Productions right as the pandemic hit. And we had plans to do some things within that entity. So it was an owned entity by Founders Live Media Inc. And that's our kind of parent company. For literally 3 years now, I basically filed a no business activity, but the entity is still there. You pay the yearly, it's like I think it's $75 or whatever, and we want to keep that going. And now, lo and behold, this year, we're going to start having activity around this area of, and that actual entity, and that owns IP and things around some production and some content. There you go, which is, if you just think about it that way, is if you have a future view of, hey, we're going to use this at some point, you're just not generating the activity this year. You just want to, it's literally like no business activity. It's $0. Doesn't cost you anything. You're not paying any taxes, but you want to keep a good standing in general, right?
And actually, I know this is. I just want to make sure that it's clear that I'm not giving people tax advice. I'm not a tax accountant, so anything that we say on here, I'm not.
There you go.
Or legal advice. I didn't say that at the beginning, but I'm sure people understand.
Yeah, well, thank you. Hey, this is a question around, you had brought up, like, let's talk about, early contributors and, as, contractors versus employees. This is always, this is a popular, very common situation, and, there's positives and negatives to it. But what should startups be aware of when they're early on, and they might still be, working with people on a more of a contract basis versus what you would maybe think about as a full-time employee? What are thoughts on that?
I mean, there's the letter of the law and there's the practical application, right? So to the letter of the law, any state entity is going to believe that if you have somebody working for your legal entity full-time, working exclusively for you, under your management, doing stuff that they really should be treated as an employee and on payroll. And what I say to clients once they've raised that outside money is we got to start cleaning that up and getting people onto payroll. Because no one's ever gone to jail for treating someone as a consultant versus treating them as an employee. And I kind of do have that bar of, are you going to go to jail for this, or are you going to just have to deal with a penalty? So again, everything about business is back to business risk. You're taking a risk by treating somebody who is that category, full-time, working entirely for you exclusively, as a, if you pay them as a consultant versus an employee. It's a business risk. What's the business risk? That you'll get audited by the IRS and by the local, whether it's the EDD in California or whatever the Washington Labor Bureau is, that they'll come and say, you paid this person, let's just say $50,000 last year. We believe that should have been paid under a payroll system and you should have paid over your payroll taxes. And they'll want to take those payroll taxes and with a penalty on top. Again, it's a business risk. We don't see it happen a ton. It does happen. We would say it happens more for established companies. Like you guys saw that whole thing when Uber were being audited by the EDD. So I don't think there's a lot of risk. And again, I'm not giving legal or tax advice here. I personally do not think there's a lot of risk for a super early stage company that hasn't raised outside money, that's just sort of trying to figure out if there's a there, treating people as consultants. But do get that contract, do pay them, don't not pay them, and then send them a 1099. You do, they're the three things you kind of have to do. You do have to send a 1099. If you don't send a 1099, that's kind of also a red flag.
Yeah.
But like I say, some risk, but not, in my opinion, in a super early company, not a lot of risk. I think the risk of starting payroll is actually higher. I don't know how much people on this call understand that as an officer of a company, once you start payroll, the payroll that you owe employees, plus their payroll taxes, plus the employer taxes, accrue personally to the officer. Payroll taxes break through what's called the veil of corporation. So don't feel you're protected by your EIN once you're running payroll. Now, if you're paying someone as a consultant and you run out of money and you go into a bankruptcy, then that goes to bankruptcy court. And again, they have to make a claim against the bankruptcy. But in payroll, they actually come back to you personally. And that's really important for founders to understand. So that's why I kind of talk about the risk. To me, the risk of starting payroll when you don't have enough funding to guarantee that you can pay people is much higher than the risk of just treating someone as a consultant and not running them through payroll. Again, I'm talking about 1, 2, 3, 4 people. If you've got 50 people and you're paying them all as consultants and they're all working full time, you've got a problem. Like you need to move on.
Yeah. Wow. Thank you for bringing that up. And, does this fall into the, when we hear about some of these, like, and again, this is like bigger companies that end up in, some sort of bankrupt, like they're like, we're shutting down. Actually, I mean, we've heard some recently in the last like 6 months, up here in Seattle, it was, like Convoy, like they, these type of companies that are large and they're like, we're done. Like we actually can't pay you anymore. That becomes a very legal issue when it's like, wait, like, no, there's an employment agreement. And if they're going to lay you off or whatever, there's certain actual, regulations on severance and other things like that. Is this what you're talking about?
I'm talking about something a little bit different, actually. Typically, when you're a big company and you're about to go into an ABC, I've been on many board meetings where a company's running out of money. But the VCs are very much focused on what's the director and officer personal liability here. And it's usually around payroll taxes and PTO, things like that. When you're actually going through a termination process, of course, there's stuff you need to do it right. Certain states have a requirement that if you terminate someone, you pay them a paycheck on the same day. Some states give you 72 hours, and you need to follow all of those laws. But I think it's just a little bit different in a really early stage company, just to understand the risk of you're running along, you have $100,000 in the bank, you feel, you want to hire somebody, you hire them, and then you realize, oh, I can't run payroll this Friday. I don't have enough cash. You don't get, that's not an option. You still owe them that money. You can't say to an employee, once they've got that legal employee relationship, well, you know what, we don't have the cash this week, work for another 2 weeks and I'll pay you in 2 weeks. Sure, you can do that. I'm sure the employee might be willing to do that. But understand that if you cannot pay them, that they can come back, the government will come back to you for that money. It's not the entity. The payroll is a personal liability, breaks through the veil of corporation.
That's
So be really careful about running. I always say to clients when I'm talking to really early stage founders, be sure you've got the funding. Look at runway before you put on payroll.
yeah.
Don't run payroll when you've got a month of runway ahead of you.
Yeah. Well, thank you. This is very, very helpful. And hopefully everyone here, you're listening or you're watching, this is quite amazing. Let's talk about that, access to funds and, funds and whatnot. Hey, maybe even, sometimes it's, it feels like it's the right idea to just get all these credit cards and, fund the company on personal credit cards, or even corporate credit cards. Are there risks around that? What do you suggest? And or look, at some point, the startup just needs to go and it needs to, yeah, as you said, is that they're there, and then can you start accessing the revenue and all that growth? But just funding off personal credit cards.
I would say most founders who've started a company are either self-funding it, and some of them are self-funding it on a credit card or whatever. And there's no risk there other than that it's your personal credit card and you're accruing that to yourself, right? I would just say be careful about that if you then start talking to investors, because once it's on your personal card, if it's not showing up on your company's books anywhere, there's a risk that an investor might come to. Let's just say, I'm going to give you a little scenario. You've spent $50,000 on your personal card. It's only you at your company. So you haven't sort of put in an expense report. You haven't shown that in the company's books anywhere. An investor comes to you and says, I'm willing to give you $150,000. Well, if the day after he or she gives you the $150,000, you write a check to yourself for $50,000 because you've got $50,000 of personal credit card debt, and that wasn't discussed during that conversation, that's a huge problem for you. So if you are using a credit card, make sure that's very clear on all diligence materials you're showing to a potential investor, even if they don't ask for diligence. Just make sure it's clear. I've been self-funding this, and be clear on what your goal is for that. I hope to get repaid that $50,000. It can be over time, or I hope that $50,000 is going to get converted into additional equity on top of my founder's stock, or I'm happy to have that sit on the balance sheet as a deferred liability until we have an exit. But be clear about it. Don't sort of hide it. Don't not talk about it. Make sure it's clear. If you're really in a formal sort of investment situation where somebody's setting a valuation to the company, again, let's just talk about a real scenario. Someone wants to give you $100,000 and they say, we reckon your company's worth $1 million. That's your pre-money valuation, right? $1 million. They give you the $100,000. You now have $101,000 in your bank account because there was no money before. And in that scenario, suddenly you show up with $50,000 that's owed to you. I mean, that's half of their investment has to go out the door immediately. So you can imagine that would be an immediate conflict. So whereas the investor's perspective might be, I was talking to you yesterday and I saw that the value of the company was $1 million based on what I saw. Yes, it cost you 50 grand to develop all that technology, but that was built into that valuation. I don't believe that the company owes you that money back. So just be really clear about that. If you're using your personal card, make sure it's clear, keep track of it, keep receipts, have a spreadsheet. And if you are asked for financials, have it show on the financials as a liability. I don't want to use words or assume and be pejorative if people don't understand what that means, but it just shows that, the company owes somebody money. So just be careful about that.
Well, yeah, and kind of within that, a note on that is just document. You can never document too much. Is that a good way to say it?
Yeah. Keep receipts, keep backup. Another thing that I think people don't know, and you mentioned corporate credit cards. So let's just say you have a company and you've got a great little company. Maybe you haven't raised a lot of money, but you have managed to get a corporate card. So you are running all of the spending through the business, whether that's a personal guarantee or not. The IRS actually have an opinion about corporate cards. They require that you keep receipts for corporate cards. That's an IRS requirement. It's written on their books that they want to see receipts for anything over $75. And so we would generally find that both GAAP accounting and tax accounting align around receipts at around $75. What that means is you have to have a receipt for anything over $75. Get an Uber ride for $10, put it on the corporate card, no problem. buy an Apple computer for $1,000, have that receipt somewhere that can be, in case you go through an audit. What a lot of founders don't know is that if you're an officer, again, back to being an officer of a company, it comes with some downsides, right? If you're an officer of the company and the IRS does come to audit you and they see a corporate credit card being used by a founder or executive without supplying business receipts, they actually will accrue that to you in your W-2 as gross income. And that's a real shocker to a lot of people. And that's, of course, you've gone through an audit at that stage, you've done a negotiation, there's always a way to, avoid these things. But if at the worst thing that could happen would be that they would say, we believe your corporate card usage was for personal purposes. You're not able to prove otherwise. You can't show me the receipt for that business meal. You can't show me the meeting that you went to. So it'll accrue to your W-2. It'll accrue as imputed income. So be careful about that stuff too. Yeah. Again, back to documentation, Nick.
Wow.
It's one of the biggest mistakes we see when we come into companies is that founders have not been keeping receipts around corporate card spending or around bank spending for the EIN.
Yeah. That's important stuff. Yeah, as you can see, everyone in the chat, if you have other questions, feel free to ask. We're here, and this is really, again, it's not directly legal advice. We're not talking to a lawyer, and even if a lawyer was on here, they would say this is not, this is not legal advice. But this is your opportunity to ask questions around, as you do the finances, as you bring on people. We talked earlier about, or the early contractors or employees. So if you have any questions, feel free to ask. Staying on that topic around, bookkeeping, maybe describe the difference of, whether it's traditional bookkeeping, that sort of thing, or the idea of around accrual accounting. These terms, some people might not fully understand what accrual accounting is versus maybe just cash accounting, those sort of things.
Sure. I mean, I kind of think of it as bookkeeping is the actual doing of the task, right? Paying the bills, running the payroll, invoicing your customers. GAAP accounting or accrual accounting is really around recording it the right way and making sure that the income statement and balance sheet of the company reflects the current business status. If, for example, your bookkeeper pays 5 bills, $100,000, but there's another 5 bills for $100,000 that they haven't paid, so that hasn't shown up anywhere in your books. In cash accounting or bookkeeping, it would just not show anywhere. In accrual accounting, that would show as a liability on your balance sheet. So again, it would be reflecting accurately the status of the company. Similar to revenue or customer invoicing. At the end of the month, you have a bunch of customer invoices you want to send out. You get half of them out. They show up as revenue. But, well, 2 things can happen there. Either you're billing in advance and it all shows up in your revenue, whereas it really should be on your balance sheet as deferred revenue, and or you haven't reflected all the revenue the company's really owed because you have an annual contract and you're billing monthly or whatever, and that's all that shows up in the income statement. So the investors have no concept of, oh, I have $1 million contract, not just $100,000 or whatever. So that's really the difference. It's really GAAP accounting sort of reflects everything that hasn't run through the bank account yet, if that's a good way to think about it. Bookkeeping is really just the cash that has gone in and out. Might be in the wrong state, might be on the income statement, not the balance sheet. It might be incorrect in the wrong category, but that's all that bookkeeping does. Perfectly. Listen, if all you get to is good bookkeeping, you can get to accrual accounting fairly fast. If you have bad bookkeeping, it's just a bigger lift. Yeah. Or no bookkeeping, even a bigger lift.
Yeah.
At least at a minimum, do some bookkeeping.
Do some bookkeeping. And, again, let's really pull it back to, hey, we're just getting started. We're making sure that we have something that is there. And, hey, maybe we tap our first 5 to 10 customers, or at least we're accessing some revenue. What do you suggest early teams do? Just to kind of like, hey, let's just get a QuickBooks going, and they're doing the basic stuff, right? And is that what you would suggest from when you say like just bookkeeping, and then a bit of general accounting, just doing the basic stuff?
Exactly. I would fire up QuickBooks Online, sync it to your bank account, sync it to your corporate credit card if you have one. So at least things are getting recorded.
Yeah.
Even if you don't know, oh my gosh, is this an asset or is this a liability? but whatever, that's fine. It'll end up somewhere. So I think to some extent, I would say yes, fire up a QuickBooks Online or a Xero, or we would probably prefer QuickBooks Online or some of these newer tools. They're relatively low cost. You can generally sync them to your bank account, so at least there's something being recorded somewhere. That's what I would say would be the minimum.
All right. Well, good. Yeah, just fire
I'm
that.
stunned that there aren't more people that have questions about accounting and HR. It's such an interesting topic.
I know. Well, we do have one. IU has sent me a message. Hey, a question on let's go back to those receipts and is everyone keeping their receipts? Most likely not. So what would you say if someone hasn't been really in that practice of anything over $75? I guess it's a two-part question. First is, if you haven't for the last few years, any suggestions of what they do? And then the second part is, what would you suggest? Like, are there tools, application apps that you think are good for, kind of receipt keeping?
Well, I guess I would say if you haven't been, start now. That's all I would say. If you haven't been, for sure, start now. I would certainly look back over the last couple of years and look at the bigger ticket items and see if you can pull those together somewhere. But for sure, start now. And we really do recommend listen, technology has changed. I always say to people, if you're doing anything in your back office the way you did it 5 years ago, you're probably doing it wrong. So look at these new tools that are coming out. There's lots of, in the world of corporate credit cards, there's lots of corporate credit card programs or expense reimbursement programs, Expensify, Brex, RAM. Mercury Bank even has some of this that has an interface on a mobile app that allows you to just take a picture of the receipt and upload it. It's not that hard. So use tools that make it easy. It's all about friction, right? Take as much friction out of the process as you can. And to me, taking friction out of the process is using a tool that doesn't do it for you exactly, but it certainly enables you to do it. So that's what I would say. Use a modern technology. Like we come into a lot of founders that are using, for example, an Amex card because they want the points or they want the whatever. But Amex has not moved with technology, right? Amex is hard to sync. It doesn't have an interface on your mobile app to collect receipts. It just doesn't have that stuff. So think about that. And like I say, on the historical stuff, I'm certainly not recommending that any founder who's focusing on getting their technology developed takes 5 weeks away and goes gather receipts. Don't do that. Just do better going forward and try and find the big ticket items from prior.
That's good. Hey, Luis, you're sitting there.
Yeah.
Any other questions pop up?
Sure. We've talked about a lot of things here today. There's a lot of, I'm sure people's minds are spinning and got all kinds of ideas. What's the best way to start with? Is it a conversation with you, Mairtini, or is it like, do they just do a little?
Yeah. I think it depends on what stage you're at, right? Like startups are about life cycle. If you're a founder in the early stages, you're dealing in tens of thousands of dollars, not hundreds or millions of dollars. In my opinion, you shouldn't be spending money on a service like ours. What you should be doing is doing your best by using like a online product that's synced to your bank account and tracking your receipts. Because I'm going to assume you're in spend mode. Again, make sure you're getting contracts signed. Just do some basic due diligence. Run your company the way you would run your personal. Well, I probably shouldn't say that because a lot of people don't run their personal finances, right?
Yeah.
Run your company with the eye of do it as best as I can. Get contracts in place. Sync your bank account. Make sure you have offer letters if you have. I see a question coming up about HR documents, so we can talk about that. That's what I would say. But once you get into significant money, and that's hundreds of thousands or millions of dollars, once you have employees, that's when you need to be engaging with a service like ours. And yes, and everyone's happy to reach out to us. We have a Founders Live landing page on the Founders Live site where you come into a little chat box for us where I can reach out to you if you need help. I generally I know people reach out to Nick about us. I generally like people to, when Nick sends our information, my general approach has been to wait to see if somebody comes back to us because some people are just back gathering and I want to know if someone really needs our service. We're happy to chat with you. I have a few of my people on this call. Gavin's on here and Alan's on here. Yeah.
Yeah. And good to see you guys over there. And thanks for being on here. And we appreciate We appreciate what you all do. So thank you. We do have a question around, let's say, so yeah, what HR documents, information should be keeping? How long is there, we be aware of this, keeping them? So maybe just a little stuff on that.
Well, it's important too around HR documents to understand like personal information and being careful of that. So you definitely need to have an offer letter, signed offer letter, a signed convention assignment agreement. And then if you are going to put somebody on payroll, or if you are going to treat someone as a consultant, they have to give you, their social security number. So if you're putting someone on payroll, the minimum forms are an I-9, because that proves that they're entitled to work in the US, and very few payroll systems will let you get to that first payroll without collecting that I-9. Super important. Again, there's a lot of risk to you if you haven't confirmed that the person you've hired is eligible to work in the US. I'm talking about the US here. That W-4 tells you how to tax them. In answer to your question, Emerald, most of the payroll systems keep those documents in their sort of data repository, so they're secure. If you are emailing out to an employee to say, please fill out this form and submit it back to me, do be careful about their information and make sure you're asking for password protection and stuff. And how long you should be keeping them, I'm not on top of the document retention rules. Normally they're 7 years plus, but that's what I would generally say. I mean, you definitely need to keep somebody's offer letter for as long as they're in your company. And certainly, we do not, I would not say any organizations have a policy of deleting old employees' documents. Just keep them on, because you could be audited at some point. The EDD could come back to you, the employee could sue you, and so then you need to be able to. Hopefully that won't happen, but if that did happen, so I don't recommend ever trashing documents like that. But I'm sure the letter of the law is probably 7 to 10 years.
Okay, very good. Very helpful there. So IU has sent me another question here. In terms of, we're shifting back to financials, and how often would you suggest founders and operators checking financial statements? And then kind of a second part of this is, and then maybe doing maybe like reviewing and maybe revising those financial projections.
Well, financial statements. So typically it goes by fiscal period. So every month you're looking at your financials. Again, it somewhat depends on the life cycle and stage of your company. If all you're doing is spending and it's just you or another person, I don't think there's a lot of value to reviewing your financial statements every month, probably quarterly and certainly annually, because you have to file a tax return. Once you're up and running and you're actually generating revenue and you really want to watch your burn and you want to be aware of what your liabilities are, typically the cadence for financials is monthly. You close the books every month. So I hope that answers that question. The second question, what was the second part of that question?
Now we shift to like projection,
planning,
kind of like planning.
Yeah. I mean, it's super fluid, right? I would not say most startups think about their forecast or their financial plan as a set in stone point in time thing. It does change a lot based on what you're doing. But I think it's always important to have certainly at least a 1 year lookout. So 12 months from today, how much am I going to spend every month? What's my burn? What's my runway? That's IO. I think IO asked that question. That's actually often dictated by your investors too. Investors will ask to see multi-year. They might ask to see a 3 to 5 year forecast. But once you're sort of in normal operating mode, we would say have a plan every year. Be doing reviewing sort of where you're at versus that plan on a monthly or quarterly basis, and make changes as you need them.
Yeah, that's that. Thank you. And I will add to that. I was, crazy enough, we didn't plan this, but that's exactly what, the way I go about it personally with our company is, just every month you should be closing that out, meaning just like, okay, like, what is your monthly statement? And you can do these on, tools like when you use QuickBooks Online and all this, but, you should really, I would suggest it's for sure, at the least, it's every month you're kind of like understanding what has happened in this month, and then, kind of close that out. You're probably recording those numbers or whatever, but then quarterly, we run quarterly, even though we're a small company. In terms of things, we still run very quarterly. And so understanding your quarterly numbers as well as your projections. So when you look at projections, having that yearly 12-month, but backtrack to quarterly. So we're literally on the recording of this date, everyone, is March 27th. And what happens in about 4 days, 5 days, I guess, I don't know, but we turn into a new quarter. And so, if you at least structure that, and now you're like, okay, maybe you had yearly numbers, you're like 2024, we're gonna do this. Well, you're a quarter in, so it's time to review where you're at, and do you need to revise for the rest of the year? So those are I think the outlooks of just if you think about driving, it's just like, okay, you're mile checking here. We got to know where you are. And, if you project it out 12 to 24 months, well, now you're 3 months into this year. Where are you? And what needs to shift and change?
And one thing I want to say, Nick, because a lot of people don't understand this. And again, I'm assuming that I'm speaking to an audience that's doing it themselves, right? As opposed to using a professional firm. So if some people kind of get confused on, but what does that mean, close out the month? In the simplest terms, all that means is you have recorded every dollar in, every dollar out of your bank account. That you've looked at your bank statement, that you've recorded it, whether it was for payroll or consulting, or whether you've received revenue. That's the minimum of closing the books or closing the month. Record. Completeness is sort of a core concept in accounting. Completeness. Everything is recorded. Accuracy is a second concept, but there's a few other ones, timeliness, etc. But record stuff. Make sure at a minimum everything is recorded.
Yeah. This is so good. So good. Well, hey everyone, this is great questions and everything. We're kind of coming to the end of the hour, and this has really been amazing. We have probably one or two more questions. Luis, I'll throw it to you. And I've got a few more on my notes here, but just kind of last thoughts here. Anyone else, you can post in there, you can say hi, you can do anything, but this has been a jam-packed conversation. Really appreciate it.
Yeah, it's been a lot. Thank you for all of this. Of course, I got to go with the easy question. What's the thing that you really wanted to talk about we haven't talked about yet? Anything super important that's like, hoping we'd ask you.
I was just trying to think of that. I was like, is there anything we haven't talked about? Honestly, I just sort of feel it's just be aware of the financial situation of your company. Get contract. I couldn't impress upon you more. Have a contract, have a paper document that governs the relationship between your legal entity and whoever the other side is, whether it's a customer, whether it's an employee, whether it's a contractor. Have a legal document, because even if it's your best friend since childhood, trust me, I've seen so many founders break apart, and not that you want that to happen, but it happens. Life happens, right? People's lives change. And don't rely on, super important, don't rely on a personal relationship between you and somebody else to govern what will happen in the future, because it's no longer personal. This is business. The relationship is between the legal entity and the other party. So I think a lot of founders sort of align themselves so closely with their company that they think they're one and the same, which is why we see a lot of bleeding of funds. They're paying for stuff personal. They're paying for company stuff out of their personal bank account. They're paying for personal stuff out of their company bank account. And I kind of talk to founders about, no, think of it as a third person in the room. It's a completely unique entity. It's not you. It's no longer you. And that entity is governed by laws. It's governed by norms. It's governed by requirements. And people suing you think of it the same way. Don't take it personally. It's business.
Yeah. Wow. All right. That was great. This is great, everyone. And we'll be closing up here just so you all can get to your next things. But so Countsy.com, you can find that online. In the chat here, if you're following along, there's a page there to connect, but you'll be able to find Countsy through our ecosystem as well. And we just want to thank you again and thank your team. This has been.
You're welcome. Super happy. We love helping founders, so definitely. I see there's another question.
Yeah, real quick. Difference between a contract with a customer or having them accept your terms and conditions.
Well, it's kind of the same thing, right? I mean, the terms and conditions are associated with the contractual arrangement. So if they accept your T's and C's, that's just your terms and conditions, though, for every arrangement. The actual contract part is exactly their customer name, your name, and what you're selling them or what they're buying. Like in our, for example, I'll bring it back to Countsy. We have an agreement where it talks about, I'm going to do your back office, I'm going to do your HR, your accounting, and I'm going to charge you this much money. But then the T's and C's are, if you don't pay me, here's what happens. Here's what happens if you sue me. Here's what happens if my employee leaves. Here's what, it kind of talks about generic things for every arrangement, as opposed to the specific contract, which is just unique to you and that customer. So there's a slight difference, I think, Emerald. And again, that's somewhat governed by how generic the product you're selling is.
Yeah. Awesome. All right, everyone. Well, we're done for today. This has been great. This is Founders Live Conversations.
Thanks, everybody.
We have really been, chatting around the back office, financials, HR, and all this, and what great questions from everyone. And Mairtini, I want to thank you so much.
You're welcome. Have a great day, everybody.
Enjoy, everyone. That's it. We'll see you next time.